All right, so I guess we can start the class now. I'm so sorry. Last week Sunday, I had to go somewhere and I traveled, so there was no way I could make the time. I think everyone can see my screen now. Everyone can see my screen, right?
Yes, ma'am.
Thank you. So we've not done lost relief. We are so much far behind. Module 3. Oh wow. Okay. I hope everyone can see my screen and it's not too tiny. Have I discussed anything on lost relief? Like any discussion? We've not done anything at all.
Nothing at all.
Wow. Did I give any assignment on what's it called? On capital allowance?
No, ma'am.
I did not give any assignments.
No, you didn't.
No problem. No problem. Let's start loss relief then. Loss relief is something very simple. If we're able to finish it on time, we'll start another topic. Okay, so loss relief. Loss occurs when a company's expenses exceed their revenue. That is, when the money that the company is spending out is more than the money that is entering the company as a whole, right? So when that particular company now experience a loss, you can relieve the loss by offsetting it against future profits. Now, the method of offsetting, sometimes businesses have more than one stream of income. A single person can sell like jewelry, shoe, clothes, that means there are different lines of businesses. So your ability to relieve loss of one stream of income from another stream of income depends on whether you're an individual or you are a company. But we'll get there, right? So now we should know that just as the government taxes our profit, when we make loss, the government also do what? Try to relieve our loss so that it's not be like, the government only sees us when we make profits. So when you make loss, government sees you as well. So we have certain rules governing loss relief. Number one, the tax authority must be satisfied that the loss actually happened. It must have been incurred specifically from the what? Business operation of the business. What's wrong with this thing? Sorry, I'm unable to move my. I don't know why it's not moving. One of zero, okay. So let me just close this and open it again. I think there's something wrong with it. Okay, it's in the proper form. All right, so we're talking about the rules governing loss relief. The tax authority must be satisfied that the loss actually happened, which means that you cannot relieve a notional loss. Notional loss is like a book loss, a loss that occurred in your book and not actual reality. Let's say, for example, loss on the sales of assets. um I don't know how to explain further on notional loss, or something like loss on foreign exchange, money that you did not actually lose. Do you get? So the loss must have happened and it must relate to the business. Number two, the amount to be relieved must not exceed the total amount of loss incurred. You cannot lose 500,000 and you want to relieve 800,000. It's not possible. So it has to be the amount that you lose that you want relieve. Loss can be relieved only against profits from the same trade or business in which the loss was incurred. So now this actually should I say, it does not relate to all the period, right? Because Under current year loss relief, you can relieve loss of one stream of income in another stream of income. Do you get? So this is just for carry forward loss relief. This is number 3. And it's saying that if you want to relieve loss from a particular business, it has to be profit from that business. Let me give a practical example. This is 2026, and I sell jewelry and clothes. Jewelry is a very profitable business, right? I don't expect loss from jewelry. But then clothes decided to show me shege. I made a loss, right? In this particular year, according to the current year loss relief, I can relieve my loss of clothes from jewelry. But the moment I move it forward, but that is only if I'm individual. You understand that better as we go on. As a company, current year loss relief is not available for a company. So I guess a company is what number 3 applies to. So now I run both jewelry and clothes. Clothes made a loss. It means that I would have to wait till clothes makes a profit before I can relieve the loss that was made in previous year. This is 2026. If a loss was incurred in 2026, 2027 loss, 2028 profit, the loss that have been incurred will be relieved from the profit. If the loss remain, you carry it forward to 2029 and relieve it again, and it will go on and on. But it has to be profit from that clothing business itself and not any other business. So from 2007, loss can be carried forward indefinitely and relieved against future profits. So this one, before, you can only carry forward loss for 4 years, but now it's indefinitely. As long as you have profits to take it up, you can keep carrying it forward. Loss available for relief should be computed on the same basis as that of accessible profit for a year of assessment. So we are saying that you should treat loss as you treat accessible profit. Just like we used to do basis period for accessible profit, you can do it for loss, right? And the same format for company income tax for accessible profit is what you use for what? For loss. Losses are not aggregated with accessible profit in computing a company's total profit. So we are saying that you should not add loss with profits. You have profit of 800,000. Like the example I gave before, I sell jewelry and I sell clothes. So clothes made a loss, jewelry made profit. If I now want to report my profit, I cannot add it together. Jewelry made profit of 800,000, clothes made loss of 300,000. I will not say that my profit is 500,000. No, my profit is still 800,000 and my loss is 300,000. They are two separate entities. I should not aggregate them together. Okay. When carrying forward loss from different assessment year, first loss incurred must be relieved before subsequent loss. So what we are saying here is that if there's a loss from 2025, another loss from 2026, 2027 there's a profit, you relieve the loss of 2025 first before you relieve that of 2026, which means 2025 loss takes what? Priority over 2026 loss. When a trade ceases, any terminal loss that could not be relieved in the year of cessation due to insufficient profit is deemed loss. It's called terminal loss. So terminal loss is when a company ceases business, but they still have loss that they have not relieved. Remember, when you cease business, it means you are no longer operating. You are no longer in operation. So there's no profits from that time or upwards, or should I say, from that particular moment that you cease business, you are no longer expected to what? To have profit. So there's no way you can relieve your loss. That's why it's called terminal loss. The loss is gone. You can no longer relieve it. The tax authority is not going to refund you of anything. It's not like capital allowance. There's no provision for carry back terminal loss under the Nigerian tax system. It's available for capital allowance only, same as 8. Claims for loss relief take precedence over claims for capital allowance. That is, we relieve loss first, then consider capital allowance afterwards. When we get to company income tax, you understand number 10 better. When you see the format for normal basis, right? So the first thing is that if you have a profit, before you can claim capital allowance, you first relieve loss. So if you have loss and you have capital allowance, and the profit can only do one of the two, is loss that you will do. And you what? You carry forward the capital allowance to the following year of assessment. I hope we're all good. So we have types of loss, current year loss relief, and we have what? Carry forward loss relief. So for current year loss relief, it applies to only individuals. Note this. It's only for what? Individuals. And it allows you to relieve loss from one source from another source of income. So it means that, like I made the example of jewelry and clothes earlier, if I make loss from clothes, I can relieve the loss from jewelry. I can relieve the loss of clothes from what? From jewelry. That is what current year loss relief is about. But to enjoy this relief, you have to what? Submit a written claim. You have to write to the tax authority that, oh, tax authority, I want to use my current year loss relief to relieve loss of this particular line of business from what? From this particular line of business. And that claim must be written within the 12 first within the 12 months after the loss occurred. That is, if the loss will occur in 2022 year of assessment, you are expected that before 2023 year of assessment, you should have like written you should have submitted your claim, because it's in the following year that you have to relieve the loss now, Abi. So before you relieve that loss, you must have written what the letter. It is limited to the first year only, which means current year loss relief, like the name says, current year, is only for the current year. Unrelieved losses are only relieved from the income source where the loss was incurred. So if the loss that you made was huge and the profits of the other source self could not absorb everything, since you have more loss that you will carry to the following year, that loss that you now carry to the following year would only be relieved from the source of income, or from the income source that made the loss initially. If cloth made the loss initially, the clothing business or the clothing line made the loss initially, and you were able to relieve some from jewelry line, you carry forward the remaining loss to the following year of assessment. That loss that you carry forward can only be relieved from profits made from clothing line and not jewelry anymore. I hope you understand. Now, carry forward loss relief is available for both individual and company. And yeah, you don't need to write any letter to tax authority. It's automatic, right? Automatically, you move your profit to the following year. And you already know that when you move profit to the following year, it means that no current year loss relief, right? It's going to be what? That same line of trade. It has to be that same line of what? Of trade. It has to be that same line of trade. Okay. So it is granted on preceding year basis and a written application is not needed. It is automatic. Before we jump into illustration, how many illustration do you have? You have just two. I think you should be able to do the two and move to, I think, investment income also. Okay, before I move to illustration, do you have any question? Olaide, your hand is up. Olaide, are you there?
Sorry, I'm there. It was a mistake. Sorry, good afternoon.
Good afternoon. All right. So again, let's move to our illustration. I guess there is no question. Okay, let me. I think it's going to be better like this. Can we all see it? The illustration, I hope it's not too tiny.
It's okay, man.
All right, thank you. Uh, okay, so Melanin Pump Limited was incorporated on September 2019 for the purpose of production of quality textile and garments materials. However, the company commenced on January 1st, 2020. Its accounting date is 31st December each year. They presented the following operational results. Compute the accessible profit for the relevant years. Compute the accessible profit for the relevant years. So this one is more or less like basis of assessment, right? We want it to, you know, show the accessible profit of loss relevant year. It's not really a loss relief, but I'll treat it like a loss relief question. Do you get? We're going to be treating it like a loss relief question. So instead of accessible profit, we'll just do taxable profit and loss. Do you get? So we are going for melanin form. I'm coming. Complete of relevant years of assessment. I'll just write this as relevant years of assessment. So we have year of assessment. I think I don't need to write that. We should be able to recognize year of assessment straight away. Let's just put the mirror sign, mirror sign. Okay. So now the company was said to have started operation January 1st, 2020. So we have the year ended January 1st to December 31st, 2021. So which year of assessment would this be now? The first 10 million loss. Which year of assessment would it be?
2021.
2021. Thank you. We have 2021 year of assessment. What we have here is what? Is adjusted profit. If you follow commencement rule, and we want to calculate accessible profit from commencement rule, the first rule says from the year of from the month date of commencement to the first accounting period. And if you see this trading period they gave us, it's the same thing as the rule. Like we're going to like repeating figures. So we're just going to assume that this adjusted profit is our accessible profit because that's what it's going to be. It's not going to change. You get. So we have our accessible profits. Accessible profit now, this one is loss. We'll write it out there. So we have 10 million.
So, Ma, will you still call it accessible profit or loss?
We can call it accessible loss, but I'll make this one negative. We can call it loss, but since in the bracket, it can also be left as profit. So now we have no capital allowance, nothing. So there's no tax. This I'm coming. Our taxable profit then is going to be 0 because we cannot tax loss. Don't forget. Because our taxable profit is 0, no site, nothing. We move to the following year of assessment, 2022 year of assessment. So do we have a profit there? Yes.
Yes, ma'am.
Accessible profits. Now we have a profit of 3 million, right? But then we have loss. Loss brought forward. How much is our loss?
10
10
million.
million. We don't have loss for the year, but we have loss relieved. We're going to be relieving everything that we have. Let's put this in brackets because it's a negative figure. Same thing. So we have, this is going to be loss carried down.
I
Loss
was
carried
thinking
down.
that it's the 10 million that will be in the jacket since it's a loss. Because I'm coming, please. Okay, so it's not compulsory. You can also do it that way.
If you put this in brackets, this one would not be in brackets.
Yes.
You can do it that way. It does not matter. What matters is you know what you are bringing forward, you know what you are carrying to the next accounting period. But this is usually how I do my loss relief.
Okay, no problem, ma.
Yeah. So you can put it like this. It does not matter actually. Taxable profit is also zero because we have used everything to relieve loss. So the following year is going to be what, 2023 year of assessment.
Excuse me, ma.
Yeah.
Please, this 2022 that has accessible profit, are we going to have edu tax,
Are we going to have?
tertiary education tax?
Yes, we would.
Okay.
We would have GET, but the taxable profit will be zero.
Okay.
So the next one is what, 2.5 million.
Hello, ma.
Yes.
Sorry, please. Are we going to have that tertiary education tax before doing our loss relief?
I don't understand.
Like, are we going to calculate that third tax before doing our loss relief?
No, you do everything after you have calculated your taxable profit. When we get to company income tax, you understand better. Everything, you will learn everything in company income tax actually.
Okay, ma.
Yes, because there's nothing there. Okay. So this is our loss carried down. I hope you guys are following what I'm doing, right?
Yes, ma'am.
Please don't get confused. Loss relief is very simple. In fact, I'm only doing it so that you understand better when we get to company income tax. If you have a question that has to do with loss, normally in advanced tax, you never see a question like this. It's too simple for you guys. You guys are tax consultants, you cannot ask this kind of question. It's just to prepare you. If you see loss in normal company income tax question, you know how to treat it. That's why I'm treating it for you. So for 2024, it's 2 million, right? Acceptable profits. Let me just copy and paste. That one will save us time. Copy. Paste. Okay. So the next profit is what? 2 million naira. It's not this place. I'm supposed to write it down. So loss brought forward is just this one that you bring forward again. Loss relief is the profits that you have. Okay, this one's supposed to be minus, so that you are going to less it. Then this one will be equal to this one.
25.
Loss carried forward to the next. This become our taxable what? Profits, no tax. 2025. Please, do we get it? Should I stop here?
We are getting it, ma'am.
Because this is basically what we're just going to be repeating. But let me continue to get to the last time. It's just 2 more years, so that you know if you're having more than one loss, how you treat it. So we have 2025. We are repeating these ones. How much is the profit? 1,500,000. Okay. I think you know this. So we're almost sure. Okay. The loss brought forward is simply this one. The one relieved is equal to the profits that we have. We're also going to be removing it from the profit itself. Our taxable profit is going to be 0. So we have the last one, 2026. Accessible profit this time around is 0. If you notice what I'm doing now, I'm going to it's going to be a bit different. Let's insert cell. Loss brought forward equals to our loss from the previous year. Now, what is going to be here is loss for the year. For the year, we have 3,200. Then they're going to be inserting another row. To give us our total loss. We are not relieving any loss because there's no profits to relieve loss. So our loss carried down is just going to be this one again. Taxable profit is going to be 0. Yeah. Okay, so we have 0. This is how we good. Do you understand how I treat this particular one? You know, this one has additional loss. And
Yes.
that's it. You have finished the question. It's an easy one, sure. Then let's do the second question. Then we can move to a new topic. Thinking you should do the question by the side. Okay. So the second question is Oladosu Nigeria Limited. They have been sustaining losses for many years, but made a good recovery in 2025. The adjusted result of the company are we have loss, profits, but we have capital allowance. Compute the company income tax liability from 2021 to 2024 assessment years. Ignore minimum tax provision. So we have Oladosu Nigeria Limited. Computation of I will not do the tax liability since you have not done company income tax. I'll just do taxable profit. Okay. Computation of let's do taxable profit for the relevant years of assessment. Okay. So just like this one, we'll have 2 naira sign. The first year of assessment is going to be, what is it? First year of assessment will be what? Definitely 2021, because from this we can tell the company is a January to December company. So we have 2021 year of assessment. And the first thing we have what? Accessible loss. How much is the loss? 350,000. So I've not put this one in there. Okay. Is somebody speaking? Mic is on.
Precious.
Who is that?
Precious, please mute this thing.
Okay. I think I've muted her. Probably a mistake. All right. So we have our accessible loss. We have it there. Remember, in this question, we have capital allowance, right? So for 2021 year of assessment, we have nothing to relieve because it's the first loss and there's no profit. So move straight to capital allowance. So balance brought forward, that will be 0. For the year, capital allowance for the year is what? 25,000. Total, total. So we have still 25,000. So now we're supposed to do restriction. You restrict capital allowance to 66 over 3%. But remember, there is no profit. So what are you restricting? You're not even going to be able to relieve anything. So immediately you write what? Relieved. You cannot relieve anything because there's no profit. There's no profit to relieve from. So our balance carried down is still going to be this particular figure. And that's it for this year of assessment. 2022 year of assessment. So we have, I think I can move this ones to make it look much more better. Yeah, to make it look good. So this one we also have accessible loss. Accessible. Let's put profit this time around. So our profit is going to be 0. Then we'll now have loss. Loss carried down to be here. What are we carrying down? This particular figure is what we are bringing forward. So, but I don't want it to be in bracket. I don't like my losses in bracket. Then I write it like this. So for the year, of course, we have a new loss. For the year, 250,000. So, total loss for the period. Total loss for the period, 600,000. So, but will we be able to relieve any loss? No, because there's no profit. So, which means that the loss that we are carrying forward to the following period is still what? 600,000. Loss carried down. Then that's the end of loss. We now come to what? Capital allowance. Capital allowance, we have, let's just copy this. So I'll not stress myself. I need to make the work faster. So capital allowance brought forward. Don't forget we have brought forward though. Equals to this our carried down from last year. So capital allowance for the year is almost 35,000, 37,500.
7,500.
So total capital allowance is going to be 62,000. Are we relieving any? No, there's no profit. So our balance carried down is still going to be this particular amount. And that's it. I don't even remember to do Canadian. I'm sorry. I forgot. This one, we are going to have what? 0. And that's going to be our taxable profit. Taxable. We have no taxable profits, don't forget. So same thing here. Can just use this one. It's not stressful. Taxable profits is still 0. Okay. So now the following year of assessment is which year? 2023 year of assessment. This one is going to be very long. 2023 year of assessment. So this one also follow this format actually, because I think they still lost. So let's just copy it. So for 2023, we also have no accessible profits because it's loss that we have. The loss brought forward is what I'm bring from last year. Where is it? The loss brought forward. Okay.
600.
600. For the year, how much? 457,000. What do you do? Just add them up. This total loss, we leave the 0 because we have no profits. So how much are we carrying forward to the following year? It's still this particular amount. Capital allowance brought forward is also what we brought from the previous year. For the year, this is the 32,000 naira. That's 2,000 naira. Total capital allowance is this. We are leaving 0 as there is no profit. So the balance that we are taking forward to the next period is this. Taxable profit is still going to be what? 0, because of course we have no profit. We have no profit. So we have 2024 year of assessment. I would like to copy and paste. So accessible profit is still 0 because of course it's loss. The loss that we loss carried down it's supposed to be loss brought forward. So I've been writing nonsense. Oh my god, I do not know. Loss for the year. Why did I not write? So this one's supposed to be brought forward. I didn't know that I've been writing carry forward since. Brought forward from the previous year. So it's going to be brought forward. Brought forward. And carried down to the next year. This one will be brought forward. Okay. So loss brought forward is the one that we carried down from last year. For the year, we have 75,000 loss. So our stock has finished here. We still have quite a number of okay. Total loss. We leave the 0 because we don't have any profits. Then this is loss that we are carrying to the following year. Capital allowance, the same thing. We bring the one from last year forward. Capital allowance for 2024 year of assessment is 45,000, right? 45,000. Then we'll add it together. Sorry, I'm not supposed to use this one. It's this one. We leave this 0. Balance carried down is this. Taxable profit is 0 because of course there's no profit initially. So then we move to the year that has profits, thank God. So that's 2025 year of assessment. If you guys should note, in this place, they gave us accounting year end. In this place, they gave us assessment year. I guess by now, you guys should know the difference between accounting year and assessment year. You guys should know the difference between the two. So please don't mix them together, right? Year of assessment is following the normal tax period. This one is following the accounting year end. So please don't mix them together. Don't mix them at all. So we have 2025 year of assessment. Is there profit? Yes, we thank God for that. But we can still use this format. So let's copy it. So profits how much? 79,000. Loss brought forward equal to the loss that we carried down in last year. For the year, thank God there is no loss. So total loss that we have is still what we brought forward. Relieved would now be equals to our total profits. Remember, I explained to you that loss have priority over what? Over capital allowance. Loss has priority over capital allowance. So our loss will reduce. Our loss will reduce. Capital allowance brought forward equals to this one. For the year, we have no capital allowance. At least it was not being in the question. So total capital allowance equals to this. Relief is equal to 0 because we have used everything for loss relief. So the one that we are carrying forward still equals to this. So taxable profits equals to 0, but we are going to be doing this. So this one will be equals to 0 because we have used everything to. So now, assuming we want to calculate company income tax under this one now, we are going to have TET. Remember, tertiary education tax is on accessible profits, while company income tax is on taxable profit. So there will be TET, there will be no company income tax. So the next year of assessment is what? 2026 year of assessment. And I think that's where we are going to stop. That's where the question stops. 2026 year of assessment. Let's copy this. Imagine writing this thing on the board. Fact. So balance brought forward is still what we carry down here. For the year, thank God there's no loss. So total loss for the period is this. How much are we relieving? All the profits again. So how much loss do we have left? This is the amount of loss that we have left. And we're carrying it to what? To the following period. Don't forget to come and remove the one that we did here. So capital allowance brought forward, you see what we carried down. Because here is 0, we don't have it. So I guess this one finish here too. But we're almost done, sure. Okay. Relieved is 0. So what we have here is still what we brought forward. Taxable profits is going to be 0. I just want to sum it up. 0, and that's it. We are sure. Any question before we move to the next module? I think you guys have gotten loss relief to an extent. It's not hard, and it's something you guys might have done in your normal taxation. Just to refresh your memory. So, Emanuela.
Okay, ma. So I just wanted to recall for us, when do we apply the restriction?
Restriction for capital allowance.
Yes,
Normally, we
this
are
is
supposed to be applying it now, but most of the question that we did today is loss. If there is loss, you cannot restrict because restriction is on accessible profits. And even in this question, throughout the whole question, we did not relieve a single capital allowance because loss have been taking up all the profits that we have. So on norms, when you get here, before you relieve, you first check your what? Let me do it here. You do your what? Restriction. I like to put it restrict. Let's assume that there's a restriction. So restriction is going to be 2/3 multiplied by your what? Accessible profits. So we have 300. Remember that you are picking the lower of the two. So the one that is going to be relieved is going to be this one because it is lower than the what restricted figure or the restricted value. Let me just delete it. I'll not confuse people. Do you get it, Emanuela?
Yes, ma'am.
All right. Some of us did not do tax in skills, ma. If you did not do tax in skills, it means you did tax in ATS3. You would have done tax in one of those two levels. Kudus, you can speak.
Good afternoon.
Good afternoon.
Hi. I wanted you to, can I get the 2025 and 2026 year of assessment? I missed some parts there, so I just want to get it. And also, I can see that the question said we should only compute to 2024. Is it that if question say that can we go further? Or we can
No,
just stop at what the question says?
you stop at what the question says. I did everything because I want us to reach the part where there's profit. If I stop at what the question has said,
Okay,
we will not have gotten to the profit aspect.
Okay, please let me see 2026 year of assessment.
There it is. So
I mean the solution.
yeah, the solution is right beside it. Can you not see the Excel?
I can see the Excel, but you are 2025, I need 2026.
This is
It's
2026.
in 2026.
Thank you. Thank you.
Okay. So I guess that's all for loss relief. Now let's move to investment income. Investment income, I'm sorry, I'm using my laptop to charge my phone. There has been no lights for like a week now, so I've been charging here and there. Okay. So we have module. Okay. I thought I did investment income. Oh, well, I think I would like to take investment income before we move into CIT. So we're supposed to do CIT first. Sorry for that, but then you need the knowledge of this in your company income tax. So I just made a mistake in the module name. This is supposed to come first. All right, so taxation of investment income. Let me see. 5 pages. We'll just find a way to like go through it so that we can finish this one today. And next class we'll do company income tax. Even if it's possible, we'll start company income tax today. So without further ado, why am I opening what document? Okay. Can you guys see it? I think it should be more. Oh, since I'm not even doing calculation, at least for now, let me just bolding this. Okay, now investment income are earnings derived from investment decision. Example, when you purchase shares, when you let out your property, or you put your cash in an account that yield interest, for example, fixed deposit account or a term deposit. Can somebody tell me the difference between fixed deposit and term deposit account? The difference between a fixed deposit and term deposit account. Anybody?
Fixed deposit and term deposit.
Yes.
If it is time deposit and fixed deposit are the same thing. But if it is just ordinary deposit account, that one you can access the account anytime we like. But if it is fixed deposit, you can give at least maybe 7 days notice before you can access the account.
Okay. To my knowledge, fixed deposit is mostly like a year. Term deposit depends on the agreement. It could be 3 months, it could be 6 months. So when the word term is used, it means that the money that you are fixing there is not an annual basis. It's not annual basis. It's like a particular period, maybe 3 months, 90 days, 6 months, that kind of stuff. But then that's what we are trying to do here. How do you treat this what investment income? We have dividend, interest, royalty, and rent. Our main focus is dividend and interest because that's majorly what you'll be seeing in your company income tax questions. Like that's probably what you'll be seeing more. And remember that the assessment for investment income is preceding year basis. PYB, dividend of last year assessed to tax this year, interest of last year assessed to tax this year. It's only when you deal with withholding tax that they remove it immediately. Now let's pick it one by one. Dividend income is the profits, that is dividend itself is the profits distributed by a company to its shareholders in proportion of their what of their shareholding. So now this personal income tax act, we have the Peter. It divides dividend in two ways. Number one is saying that profit distributed by a company that is not winding up, that is a company that is not being liquidated. So when the company distributes its profits and is not winding up, it's regarded to as what dividend. So it means it could be bonus shares, debenture, security awarded as long as share dividend. The second way that it defines it is profit distributed by a company that is being wounded up other than those of capital nature. So it means that even if your company is ceasing operation, they can still distribute profits. And don't say because they are ceasing operation, you should not regard it as dividend. As long as it is profits that they are distributing and not capital. That's why they put the word other than those of capital nature. And it is not capital that you paid to them that they are giving back to you. Then it is to be regarded as what dividend. Now, there are some dividends that are exempted from taxation, which is exactly why we are treating this topic, because this one will always come up almost all the time in your what company income tax. So you have to be able to know whether that dividend is a what is a non-taxable income or not. So number one, dividend by a Nigerian company and satisfied by the issue of shares of the company paying the what dividend. So dividend by a Nigerian company is not taxable. We have by the issue of shares. Okay, it means that the dividend was paid using what bonus shares. Bonus shares is not taxable. That's what they're telling us. I think somebody have asked that question. I don't know whether it's this class or the skills classes. I know somebody asked me if bonus shares was taxable. Dividend by a Nigerian company out of any profits exempted from tax by any provision of the act or by the fact that the company enjoys a pioneer status. So it means that the company that is distributing dividend, if their income is exempted from taxation, then you should not tax the dividend that they pay to their people too. For example, pioneer status. No, we are going to do pioneer by God's grace, probably after company income tax. Then you would understand what pioneer is. So for a pioneer company, for the first 3 years, and if they wish to extend for the first 5 years, they would not pay tax. So for such a company now that is tax exempt for a particular period, dividend that they pay for that period is also what tax exempt. Number 3, dividend paid out of profits chargeable to tax under PPT. Dividend out of any profit chargeable to tax under PPT. So if dividend is paid by a petroleum company or by a company that their own is not SITA, their own is PITA. When you do hydrocarbon, you understand this better because the profits that is but the hydrocarbon has changed everything, sha. When you get to hydrocarbon, you understand matter better. Just put it in mind that if the dividend is from what a petroleum company, then you should know what charge it to tax. Payments of dividend by a Nigerian company to a Nigerian company. So we are saying Dangote, Nigerian company, paid dividend to BUA. Let's see, Dangote Cement paid to BUA Cement. No, they are both Nigerian companies. So how do you treat it? Dividend distributed by a Nigerian company shall be deemed to be from Nigeria and shall be the gross amount of that dividend before deduction of any tax which the company is required to deduct. Let us first pause there. So now, if dividend is distributed by a Nigerian company, you should I say you assume or you accept the fact that that dividend is seen to be derived from Nigeria. It means it's a Nigerian dividend, right? And that dividend, the amount that you consider for that dividend is the gross amount before they deduct anything. On months, in professional, you guys are not treating withholding tax. That's why we do not do withholding tax. But tax skills people have done withholding tax, right? I'd be sorry, we were supposed to do it yesterday, but there was no light. I could not teach them. This withholding tax is not something that is new, but let me just glance through. Withholding tax is what advance payment of company income tax, in which the person that is paying you money will remove that withholding tax before paying you the remaining money. Now, dividend that they have paid a particular company, like the example now, Dangote Cement want to pay Bua Cement dividend. Before Dangote Cement pay Bua, it has removed withholding tax, 10% withholding tax, right? So it paid Bua Cement 90% of dividend. The 90% is called net dividend. 100% of dividend is called gross dividend. So this is not telling you that what you consider is the gross dividend and not the net dividend. Remember, it's a Nigerian dividend, and you have to consider what? The gross dividend and not the net dividend. Now we can move forward. Dividend received from a Nigerian company are to be regarded as frank investment income, because withholding tax deducted on such dividend is treated as the final tax. Now let's speak on this. It is the main reason why we are treating this topic before we do CIT. Frank investment income. Write it somewhere that you never forget and you can always come back to it. Frank investment income are income on which withholding tax is the final tax on the income. And the only example that we have is dividend. Before it was dividend and interest, but now it's only dividend. It's only dividend that fall under this. That is dividend received from a Nigerian company. If you receive dividend from a Nigerian company and they have deduct withholding tax from it, that withholding tax is the final tax, which means that when you are doing your company income tax and part of their income, you can see that they received dividend from a Nigerian company. What are you supposed to do? You remove it. You are not supposed to tax that income in your company income tax again. Why? They have removed withholding tax, and withholding tax is seen to be what? The final tax on such income. I hope you are good. Even if they write gross, I mean they write net, remove dividend. Remove it, don't tax it. So now let's move. Dividend received by a company from another company incorporated in Nigeria is exempted from tax. I think we've already established that fact. Provided that the shareholding interest in which dividend is payable is either wholly paid in foreign currency or by assets brought into or imported by Nigeria. So now we are saying that if how can I say it? Dividend received by a company from another Nigerian company, I want to exempt dividend from tax. It has like how can I say it? Should I say cave? Yes, something like that. But please, when we are doing CIT, all this one that we are saying, it does not matter. Is that frank investment income that you consider, please? That's the main reason why we are doing this one. Okay, so now number one, the dividend, that the money, how can I say this? The capital. For you to have received dividend, it means that you have bought shares from a company. You bought that shares using a foreign currency, or you use an asset that you imported from another country into Nigeria to buy your shares. So in that case, the dividend that they will pay to you is exempted from tax. And that's your dividend, that your shares that you got is not less than 10% of the shares of the company paying dividend, which means that you got like 11%, 15% upward. It has to be 10% upward, not less than 10%. So now, for the purpose of the exemption, tax-free period shall start from the year following that in which the new capital is brought into Nigeria. Shall be 5 years for agricultural trade. And okay, so now let me explain this. So we said that dividend that fall under these two categories, that is, if you use foreign currency to buy your shares and your shares is more than 10% of the company, they will not tax you on that dividend. Probably it includes withholding tax too, I guess. They will not tax you on the dividend. Now, but for you to enjoy this tax-free period, like within what is the time frame? What is the time frame for you to enjoy this period? for an agricultural business, or if you are doing petrochemical, this is it, I should have bolded it to petrochemical or liquefied natural gas. So we have two things here. We have agricultural number one, number two, petrochemical or natural gas. Those two shall be 5 years. If those two business shall be 5 years, but all other business is going to be 3 years. So for 3 years, do not tax your dividend. Where the dividend is distributed or paid by a Nigerian company, the dividend shall be deemed to be derived from the territory in which the recipient of the dividend resides, or where the recipient. Let us first talk about that before we move to war. What they are saying here is that who will collect the tax? You know that when we talk about dividend, shareholders can be individual shareholder, can be corporate shareholder, which means, like the example that I made, Boa Cement can buy shares in Dangote Cement. That is a corporate shareholder. Me, as a person, I can buy Dangote Cement shares. That is an individual shareholder. I am to be regarded as an individual shareholder. Why? Boa Cement is to be regarded as what? A corporate shareholder. So now, if they're not talking about an individual shareholder like me now, and I receive dividend, Boa Cement is like, I don't even know where their office is, but let's say Lagos. I'm here, I'm in Ibadan. I stay in Ibadan. Who will now tax my money? Is it Lagos internal revenue? Is it Ibadan internal revenue? Abi Oyo internal revenue? Who will collect the tax on the dividend? And that's what we are trying to see here. So now, if a Nigerian company now pay me, for example, like we are saying, Dangote Cement has paid me dividend, the person that we like the dividend, the dividend will be said to have been derived in the territory in which the recipient resides. I am the recipient of the dividend. Where do I reside? I stay in Ibadan. It means that the dividend would be seen to derive in what? Oyo State, which means Oyo State Internal Revenue Service will be the one to collect the tax on my dividend. Yeah, I have not scattered everything like this. Do you guys understand what I'm saying?
Yes.
Esme, you have a question. Esme, your hand is up. Esme is not speaking now. The second person whose hand is up again, the person can speak.
Good afternoon once again. So what I wanted to ask is that, we're talking about dividend. Now that the Nigerian law says that the Nigerian tax law says that any investment that you do in Nigeria is going to be charged withholding tax. So does that kind of income, how do we now? Are we now going to tax it? Are you not going to charge withholding tax again, or how do you go about that income? Just for example, like Boa Cement that I said, did a treasury bill. Now, when you do the treasury bill at maturity, they now charge. Okay, no, in the first instance when they do treasury bill, they are going to give you discounts. So upon maturity, they are going to charge you 10% of your interest that you have in charge of maturity. So how are they going to charge the income?
The income is the interest. And
yes, the
let me
interest,
give
right?
you a practical example now. No, I told you I work in an accounting firm, and we have somebody, a client that fall into the category that he just said. I was the one that personally handled that particular assignment, and I think I have a practical knowledge of what you're asking. So I was confused as well because I had to go and meet my boss and tell him that the only thing that is in this person's statement is the interest now. So how do I tax? How do I tax? It's just like he said, that's how I got to know the difference between term deposit and fixed deposit. It was my boss that taught me like a week or 2 weeks ago. So I asked the question and I told him that the only thing we have here is the interest from the term deposit that this man has been doing. There's no other thing. They're like, yes. How do I do it? How do I tax it? And mind you, withholding tax have been deducted before they remit the remaining, which means what I have that is in his bank account, that is in his book of accounts, is the net interest and not even the gross interest, right? So, like your question, how do we tax it? The thing, our own is that the company that is paying the interest is not the one that will tax you. They have done their job by removing withholding tax and giving you the remaining money. You, as whether the company or the individual, will be the one to now add that interest to your other income. If it's a company, of course, a company will have any other income. For this particular company that I handled, they don't have any other income. Their work is just to be putting, what's it called? I don't know. I honestly don't understand that thing, but it seems strange. But of course, they're making their money, and that's the core of the business, right? To make profits. So, interest is their only income, no other income, and that interest form their what revenue. Do your revenue, no cost of sales because it was the interest only that we took as revenue. The only expenses that we have is the bank charges that they keep removing whenever they send money or receive the kidney. And what do? You did everything, taxable amount, company income tax on it. Then do you get? So that's it. You charge interest, you charge tax on the interest on the residual value that they sent. That's what you charge tax on. You get it.
Okay, I would say I get it to some extent, but what I'm trying to say now is that I know when you do treasury bill, you're going to be
Yes.
charged discounts as the interest at the initial stage.
Mm-hmm.
Let's say you did an investment of 10 million naira and the interest is 20%. That means you have they will charge some other custodian fee and everything. So you are operating to have about 1.9 million. Are you getting me? Like, let's say you did it today and the investment will end next year. Are you getting me? So next year, when it matured, the bank now charge you 10% of what they have given you as interest this year, next year. They're supposed to pay you back 10 million at maturity. So now 10% of what you have interest, that's 1.8, is like 180,000. And that debit you, they not credit you 9,820,000 in next year. Do you understand what I'm saying? That means they deduct their own with that. So are we now, say that it has come into 2 years now. Are we going to charge the income this year or that next year when they charge withholding tax?
Okay, now I get you. You are saying that, like, is the tax going to be in the year where you pay the money or when you receive the interest?
Yes.
It's when you receive the interest. When you receive the interest. Because for the interest to have come in that particular year, it relates to both years, right? It relates to both years. And though if you follow the matching concept, you're supposed to divide that money. The income that relates to the previous year should go with the previous year's revenue. The one that relates to that particular year should go to that particular year. That's if you follow the matching concept. Well, because in this investment economy, we're still going to explain interest. We are still on dividend, but we'll get to interest. So there's a way when are you supposed to tax it? Like, when is it taxable, right? So when you receive the money, it becomes taxable. Then you just add it up with your other income at that particular time. Other income at that particular time. Since it's not like your major, even if your major source. That's how I did that other accounts. I did not think of the fact that some had some days in last year, the upper year, and some had in last year. I just summed up the entire interest I was gotten on the time deposit. Do you get? Regardless of the fact that it was coming from the previous year.
Okay, thank you.
You're welcome. Etim, are you still there or should we move on?
Yes, ma, I'm here, ma. Good afternoon. Good evening, ma.
Good evening.
Good evening, ma. Thank you for this lecture. You emphasize on frank investment, and you said the reason why you're taking this topic right now, interest, it will help us on CIT, and you emphasize more that's a frank investment. So I wanted to throw more light on that frank investment. Though I've heard it before, but I seem not to really get understanding about it. Thank you.
Okay. So what I'm saying about frank investment income is the fact that withholding tax on frank investment income is the final tax on that income. And the only frank investment income that we have now is dividend. Before it was dividend and interest, which means if you have removed, like the example, what was it, guy? the guy that asked question before you, the example that he gave, interest on treasury bill. Before, when interest was still a frank investment income, that particular question that he asked, that withholding tax would have been a final tax, which means no other tax other than that withholding tax. But now, interest have been removed from frank investment income. I'll call it FII. The only FII that we have now is dividend. So if you have dividend in your question, you should know. But they don't have to tell you in the additional information before you can know that that dividend is not to be taxed, because they would have moved withholding tax before paying. As long as dividend is from a Nigerian company, sometimes they will write it in the additional information that this dividend is from a Nigerian company. That's int for you. That is FII, and you should not tax it. Remember that it's only if that dividend is from a Nigerian company, right? So withholding tax will be the final tax, last tax on that particular what? On that particular, my laptop is getting low. You know, I'm also charging my phone from it, so my phone will not die. So let's go. I want us to finish this one, even if we cannot move to another topic, please. Let us
Okay,
start.
thank you, ma. I understand. Yes, I thank you so much. Thank you.
All right. So where the recipient is not a Nigerian recipient, I think we understand this on territory now. I think I use myself as an example. If I receive the dividend from Dangote Cement, the tax authority here would be the tax authority of where I stay. I stay in Ibadan. So it's your state internal revenue that will receive what? The withholding tax on my what? On my dividend. I hope we are good. But if the recipient is not a resident of Nigeria, that is, the person is a non-resident, the person shall be deemed to be a resident outside Nigeria who derives income or profit in Nigeria. That is, you might not be in Nigeria, but you are getting profit from Nigeria. And dividend derived by non-residents shall be deemed to be derived from the Federal Capital Territory, that is Abuja. I hope we are good. Me as a resident, you have to look at where I stay. The meeting mumba dividend here, the meeting mumbe near to Magba tax. Do you get? So where I reside is the territory that would collect the tax on my dividend. But if let's assume I'm not in Nigeria, I don't even stay in Nigeria, I just bought the Dangote Cement from one half, let's say truth. So the withholding tax on my own dividend is going to be paid towards the Federal Capital Territory. That is going to be derived from there. Now, payment of dividend by a Nigerian company to a non-Nigerian company. So when you pay to a non-Nigerian company, it shall be exempted from tax. The amount of withholding tax in connection to short dividend is the final tax on those payments. That is, no further tax is payable. Now, this one, if I remember quite well, withholding tax for non-residents, okay, to a non-Nigerian company, sorry, non-Nigerian company is like withholding tax is the final tax. If you pay dividend to a non-Nigerian company, you're not supposed to tax that dividend apart from withholding tax. It's like FII, but in a different, because of course we are not calculating company income tax for a non-Nigerian company, so that one does not concern us. What you shall know is that dividend to a non-Nigerian company is withholding tax that you are going to tax the dividend. After withholding tax, that's all. Now, excess dividend. Provisions of Finance Act 2019 on excess dividend. Before the Finance Act, companies were to tax 30% on their dividend distribution where such dividend exceeds total profit for the year. Though the profit may have been taxed in parallel, exempt for tax or tax on that. So now let me explain this because you might not understand. If you have done CIT, you would have understood, but since I've not done CIT, you don't understand this. Let me try to shed a little light on it. So to compute your company income tax, you have like four bases or four methods of computing company income tax. One of it is the dividend basis. And the dividend basis is telling us that if a company in a particular year of assessment made a profit and they now paid dividend, the amount of dividend that they paid is higher than the profit that they made. You made a profit of 300,000, but you paid dividend to your shareholder of 500,000. In that realm or in that situation, the tax authority can tell them to pay tax on their dividend instead of their profit. So because they believe that where did they get money from? If you are paying dividend of 500K, but where do you get money that you are paying for your people? So instead of doing 30% of your taxable profit, you'll be doing 30% of what dividend paid. But people now complained, like they said, people complain that this money that we are adding to the profit, it could have been from our retained earnings. It could have been from income that was exempted from tax, thereby making our taxable income smaller than the normal gross income. Or it could have been income that has been taxed under a different rule and is therefore exempt from tax in Nigeria. So you cannot just tax us on our dividend like that. Do you get? So because of that complaint, Finance Act 2019 brought forth some changes, right? So it's not saying that this particular law that Finance Act 2019, this particular law, it affects what? Companies that have subsidiary in Nigeria. Companies that has what? They have subsidiaries. Or companies that have subsidiary in Nigeria or outside Nigeria. It affects them a lot. Because if their subsidiary is giving them money, if I don't know when you do double taxation, I'll be the one to teach you double taxation and maybe too. God, we are lagging behind you, honestly. We'll find a way to do extra time at this rate, honestly. Because we do under double taxation, income that have been taxed in another country, it's not supposed to be taxed in Nigeria. And it's even the tax is an allowable expenses. When we get to the TA, we'll talk about that. So now, my subsidiary have already paid tax on the income. Then I brought the income to Nigeria. It's no longer being taxed. I use the income to pay dividend. And you're not taxing me on my dividend again. Is that not the same thing as you taxing me on that particular income? It's making Nigeria unattractive for group companies to come. Now, the Finance Act 2019 has said that, okay, we have listened to you. Now, this 30% on dividend is going to be limited to profit that have not been taxed before. Profit that are not tax exempt. So now, let's check. The following no longer counts towards determination of excess dividend. Number one, retain earnings on which adequate tax have been previously paid. So if we have this out of the dividend that they have paid, you remove it. Exempt profit, that's profit that are tax exempt, you remove it. Franked investment income, if it's there, you remove it. Dividend paid by a REICO, that's real estate investments, you remove it. Then, the year to which profits relate is also now irrelevant. The possibility of a company paying excess tax is now limited, which means that dividend tax is less likely, because if you clarify and you can prove that the reason why your dividend is higher than your profit is because you have these things in it, then of course they will not tax your dividend. I hope you understand that one. Interim dividend paid by company. So before the Finance Act 2019, the companies pay dividend before filing their annual corporate tax shall be subjected to the company income tax rate of 30% of dividend paid, and such tax shall be paid to FIRS. Interim dividend is like middle dividend that you pay before you even finish the financial year. Some company pay dividend 2 times in a year, or 4 times in a year, 3 times in a year, depends on what after they do the quarter report, you can tell that they are paying dividend or not. So you're not saying that before 2019, you have to pay 30% on that dividend, interim dividend that they have paid. You pay tax on it, 30%. And that money is payable to what? To FIRS. So the tax paid is based on dividend that they have paid. But with the implementation of Finance Act 2019, tax on interim dividend is no longer what's applicable. It has been cancelled. FII, I think I've explained FII. I don't think I need to repeat this one because I've said everything that needs to be said about FII. Now, that's all about dividend, please. That's all about dividend. I'll be uploading this by God's grace before this laptop die. I'll upload it to the drive so you guys can go through it again. Now, we have interest income. The income from any interest on money lent by an individual, that is, you lend money out to collect interest with executor or trustee outside Nigeria to a person in Nigeria, including a person who is resident or present in Nigeria at the time of the loan, shall be deemed to be derived from Nigeria if, now, we are saying that income from any interest, like you have an interest income, and the income is from outside, like the money is coming from outside Nigeria, to you that you are in Nigeria. So even though it's not coming from Nigeria, it's coming from outside Nigeria, we are going to say that this income or this interest is derived in Nigeria if, number one, there's a liability to pay the money in Nigeria, regardless of what form that the payments made. Maybe it's electronic payment, anything. So it has to be the liability to pay in Nigeria. You have liability to pay that money in Nigeria, number one. Number two, the interest accrues in Nigeria to a foreign company, regardless of what form the payment takes, or how the payment, or whatever the payment is made. So, number one, liability to pay in Nigeria. Number two, the interest accrues in Nigeria. So now, interest from a source outside Nigeria, is that not what we just explained? Wherever an individual is resident in Nigeria, interest accruing to him from a source outside Nigeria is liable to tax in Nigeria if it is brought into or received in Nigeria, subject to double taxation provision, if applicable. So this here is if applicable because it's not every country that Nigeria has double taxation arrangements with. Do you get? So now there are some interests that are exempted from tax. Number one, interest on foreign loan. So foreigners give you loan. But this one, only caveat too. So the caveat there is that, well, I think it's in CIT that we learn that interest on foreign loan is limited to, I think 30%. Is it 30%? I don't really remember the percentage. 30% of your EBITDA, earnings before interest, tax, depreciation, and amortization. Because this interest on foreign loan, I don't know if you guys have done BEPS, base erosion
and profit sharing.
Exactly. Have you guys done it?
Yes, ma'am.
I think you should be able to understand me better now. Interest on foreign loan can be used to do what? To erode your tax base. Companies will be saying that their subsidiary abroad borrow them money, and it's a lie, yo. It's a lie, yo. It's not borrowing. They are using that interest to carry profit from Nigeria outside Nigeria, usually to a place that have lower tax rates. So they will not carry profit from Nigeria. They'll go and take it to Ghana, a bit to US, they have lower ticket, anywhere that their tax lower than Nigeria. So because of this, Nigeria people are saying, hey, so this is what you guys are doing. Did not give them what? A condition that if you are paying interest on foreign loan, the interest must not exceed 30% of your EBITDA. If it should exceed 30% of your EBITDA, then will disallow the remaining interest. Then you can carry it forward to the following year. Maybe get CIT, we'll talk about that. Because I saw it in one of your questions, and I put the question in CIT material. So you definitely come across it. So that's one, interest on foreign loan. Number two, interest accruing to a person on foreign currency domiciliary account. Foreign currency domiciliary account is like an account that receives foreign currency for you, right? If your money is in domiciliary accounts, they're not going to tax you. It's one of the ways to reduce your taxes. You keep your money in domiciliary accounts. But I feel like it's a temporary solution because the moment you remove your money, they will tax you. The moment you remove your money from that account and you need to do something, except if what you use the money to do is also tax exempt, then okay, you keep enjoying a tax-free period, right? But as long as your money is in the domiciliary account and it's receiving interest there, they're not going to tax you on the interest. So interest on loan, and this one relates to what? Agricultural trade, right? And also on loan granted by a bank for primary agricultural production is exempted if the moratorium period is 12 months. This moratorium period has total. I don't really understand the moratorium period. I tried like making my research on it because I did not really understand it. So we're not going to dwell much on moratorium. Just know that interest on loan to agricultural business is exempted from tax. So that's on interest. Royalty. There are payments made to owners of property to use their property or their patents or their copyright work or franchises or natural resources. Those are what? Royalties. I think we would have had royalty now. We do it in accounts. I think probably it is it one or two? I cannot remember. So royalty, all these royalty accounts that you do. So royalties are often expressed as percentage of revenue obtained by using the owner's property, but can be negotiated, right? So royalty earned from abroad and brought into Nigeria through government approved channel shall be exempted from tax. So if you bring your reality from, let's say, abroad, maybe you have land in Texas and you are farming on it, or you have like animals or something on it, you can bring it into Nigeria. It's going to be exempted from tax, right? So that's all like the pack talked about in reality. But all of these ones is usually not the rental income, interest, and dividend are usually what are in your CIT. So we have rental income, which I think will be the last one that we'll talk about. Rental income is the gain or profit from letting property. It is generally deemed to accrue daily over the rental period. So even though we pay rent yearly in tax realm, they assume that your rent is accruing every day. So it's a daily expense to tax people. So now rent received in advance. Rent received in advance is spread over the rental period, which means that if you receive rent 3 years in advance, you not say that the income is like, for example, let me use a figure. Your rent is 1 million per year. The person has said, oh, I have rent for 3 years. I don't want to spend it. Let me pay for 3 years. Even though the person is supposed to pay for 1 year. So you're not collecting for 3 years. So you not recognize that 3 million at once, according to tax people. You divide it by the 3 years, which means 1 million. This year you recognize 1 million. The following year you recognize 1 million. Last year you recognize 1 million. But let's say, for example, the person paid like 10 years in advance. 10 good years, like I have the money, I don't want to spend it, and I don't want to hear rent has increased in the future. So let me pay for 10 years now. The person has paid for 10 years. According to the tax authority, the spread period, the period at which you can spread that rent must not pass 5 years. So even though the person has paid for 10 years, it's supposed to be divided by 10. Or you divide it by what? By 5. So that 10 million will be divided by 5. Instead of recognizing 1 million per year, you're not recognizing 2 million, 3 million. When that 5 years now ends, number 6 year, zero income, 7 0 income, 8 0 income, 9 0 income, 10 0 income, before the person has to pay another month in what? 11th year. I hope you get. So the law is that if rent received in advance, covering a period that is more than 5 years, you will spread it for what? You will spread it for 5 years. Thus, for tax purposes, gains or profit arising from rent of property is ascertained by deducting only the expenses that was incurred for the purpose of earning the income. So it means that we have allowable rental expenses. No, it's rent now. The property that you're letting out, it surely need maintenance. Whether it's house, abi all this canopy or chair, you shall wash canopy, you wash the chair. Abi, if it's house, you take care of the house. Maybe there's plumbing issue, you do it. Roof leaking, you fix it. You have to, there's maintenance cost, right? So we are telling you that it is an allowable expense. As long as that expense is for the purpose of earning the income, you are allowed to remove the expenses before you are taxed on the remaining figure. So we have allowable rental expense. Number 1, tenement rate or land use charge. So if you are paying tenement rate or you are paying land use charge on the rental property, you can remove it. Cost of collecting the rent. Maybe you are represented by your lawyer or agent. No, this or the only people. They collect money from the person that is renting. They collect money from landlady, everybody. They will pay. Cost of advertising for tenants. Maybe if you do advertisement on radio station, television, you can remove the money. Expenses incurred for repairs and maintenance, you can remove it. Bad debt. Some people will owe you money. They run away to another house. There's nothing you can do to law. You can remove it as an expenses. Interest on money borrowed and employed in renovating the property. So let's say your property needs a very big renovation. You cannot afford it. You went to the bank, you borrow money, bank collect their interest. The interest that you are paying to the bank for that money that you use to renovate the property is an allowable expenses. Then commission paid to agent or caretaker. I think we've talked about that before. Insurance premium paid on property and water rates. So if you have insured your property and you are paying premium on it, it's an allowable expenses. But these allowable expenses for rental for rent, allowable expenses for rent is number 1. Any expenses not incurred for the purpose of earning the rental income, that is not really for the rental income, is going to be disallowed. Expenses of capital nature is allowed. Depreciation of the building or the rental property is allowed. Appropriation of profits, including income tax, during reserve. So this appropriation of profit is like, maybe you are not the sole owner of the property. So you now have to give some of the co-owners money. You now want to remove it as expenses. It's not allowed. Though. It's not allowed. or you withdraw money from your capital, you now say it's an expense. It's not expensive, it's a drawing. It's not expensive. It's not allowed. Serve, you kept money. You serve now, retained earnings. You now say you want to remove the expense. It's not allowed. Those ones are not what they are not allowed. So that's all about extra income. I didn't know we have this one here. Real estate investment company income. These ones are like companies that help with real estate investment, and they shall be liable to tax. They shall be liable to income tax on management fees and other income earned when less than 75% of income is distributed to shareholders, and when dividend distributed is not made within 12 months. I think we need to talk on this again. You would have never seen a question on this right place. It even looks strange to me, Sha. But I just had to put it since I saw it in the pack. So now they're saying that they are going to pay income tax on the management fee that they collect from their people. No, these people, they collect money from different people, whether you're a company or you're individual. They put it together and they invest it in real estate. So it means that most of the income that they derive is going to be distributed as dividend, because of course that's the purpose of collecting money in the first place. But they are not doing it for free. But what is charity? They will collect their money. So their own money for doing it for you is the management fees, right? Maybe they have other things like maybe commission and other things. Their management fees and other commission, they have to pay income tax on it. When 75% of the income is distributed as shareholder, when less than, which means that if you have more than 75% distributed, maybe you're not going to pay tax on it. But as long as the dividend that you have distributed is less than 75%, and you do not even distribute the dividend within a year, which means you might have even invested the dividend before you distributed it. You might have used it to acquire more money. You might have used it to acquire more money before you what? Sorry. Before you distributed it. Number two, dividend to shareholder is liable to 10% withholding tax deduction, which means that before you even, how can I say it? Before you pay to shareholders, you have to remove withholding tax. Remember, I think when we talk about dividend from this company is also part of the ones that you don't tax again. Withholding tax is the final tax on them instead. So that's all about investment income. I hope when we see these questions, I hope you guys will understand. Help us the material and loss to give an investment income. I'll put it now. I'll put it because my battery is even low, so I'll have to put it right now. When we come across these things, when we are doing company income tax, do you know what's going to happen? Let me save this. I want to upload it on the drive now. Then we can continue company income tax till my battery gives up. Pata. Do you get? So I have to back this. Let me. So I would upload it. Then we can start company income tax. Since my battery is still on, we just have to stop whenever the stuff network is not so good. But I did not expect the battery to last for this long because wow, it really tried. I'm putting my phone in between two pure water so the phone will not die. Okay. So we can start company income tax. So by next class, we ensure that we'll reach calculation aspects, investment income, loss relief. I think there's one calculation of what we just said. Okay. Okay. I think we have it already. All right. It has been uploaded. Let's go with this now. Now let's start company income tax. Okay. This is a question that I was talking about. Okay. Well, we'll get there, Sha. We'll get there. How many questions did I put for you guys? Okay, 3 questions. Go back. All right. Now, company income tax. Please, before I move, I never asked if you guys have any question before I move to company income tax. Is there any question? No question, I guess. All right. So for company income tax, the first thing is what? Classification of companies. Classification of companies. Before this new tax act that we have, this tax reform, companies have been classified into three: small company, medium companies, and large companies, right? So small companies are companies with gross turnover of 25 million or below. So we have sales equals to, or sales revenue equals to, or less than or equals to 25 million. So if your sales is less than or equals to 25 million, so you are seen to be a small company. Less than or equal to 25 million, then you are seen to be a small company. Their tax rate is 0%, which means they are not expected to pay tax. They're exempted for paying what? Company income tax. They're exempted from paying company income tax. But they must have registered for tax purpose. They have to file their tax return on or before the due date, and they must comply with all other provision and obligation under Company Income Tax Act. Please, I hope you get that. So because small companies are not paying tax, does not mean they should not file their return. Does not mean they should not register for tax or for VAT or any other thing that they're supposed to register for, right? So that's for small company. But for medium company, they are company with turnover greater than 25 million, but less than 100 million. It means that if your turnover is greater than 25 million, but it's still not like up to 100 million, then you are a medium company. And you're going to be paying what? 20% tax rate. 20% tax rate. But for large company, they have turnover of above what? 100 million. Small companies have turnover of above 100 million. And their tax rate is 30%. But for the new tax act, but please, before I go to the new tax act, for your diet, don't consider the new tax act, please. Because I just want you guys to know it. Written aspects can come up, or maybe, I don't know, you might need the knowledge in the exam. That's why I have it here. So follow this based on Finance 2019 home, because that is what is testable in your own diet. It's until next diet that they will start testing the new tax act, please. But just know it for no sake, just in case. I don't want you to dwell on the new tax act because it's not taxable in your diet. I hope you get that. So, but according to the new tax act, we have just two classification of company. We have only small company and large company. There's nothing like medium company again. So small company are company with turnover. When I say turnover, I mean revenue or sales. It's the same thing, turnover. Their turnover is below what? 100 million. Or they have fixed assets below 250 million. So the above conditions still stand. It means that their tax is still 0%, which is very favorable because before it was 25 million, now it's 100 million, and they are paying 0% for below 100 million. But they still have to register for tax purpose. They still have to file their returns, because how will the tax authority know that true your revenue is below 100 million if you're not filing your returns? You have to file your returns, right? So, but for large companies, if their turnover is above 100 million and their fixed assets is above 250 million, they are classified as a large company, and their tax rate is what? 30%. 30% tax rate. No, that's it. Now, determination of assessable profits. As discussed in Module 1, accounting profit is not directly used to compute tax payable. No, it has to be converted to a tax profit known as the adjusted profit, which considers tax law, exempt income, and allowable or disallowable expenses. So, example of how you do that, how you turn accounting profit to adjusted profit is this. You have your net profits. You know, in the financial statement, we have net profit now. That's profit for the year. Then you now deduct non-taxable income. You have disallowable expenses. Then you have your what? Adjusted profit or loss. Now, company income tax is a tax payable on the profit of a company accruing in, derived from, or brought into Nigeria, or received in Nigeria, right? So a company can be charged with tax in its own name, in the name of a principal officer, in the name of a receiver or a liquidator. Now, what is taxable income? Taxable profits are those in respect of number one, any trade or business for whatever period of time such trade may have been carried on, which means that any profits that you get from your trade or business is a taxable income. Rent or premium from a right granted to another person for the use or occupation of property. That one is also what? Taxable. Dividend, interest, discount, royalty, blah, blah, taxable. This dividend that they wrote there, don't forget your FIRU. Please don't forget it. It's taxable income, but remember that if you have removed withholding tax, then it is not what? Taxable. Please put that at the back of your mind. Any source of annual profit or gain not falling within the preceding categories. You know what they did here is that, I think I've written it there, the purpose is to ensure that no profit escape the tax net. They have already written 1 to 3. And you know, we are people now. Some people's income might not fall under those 3 that they have listed there. And they will not pay tax. If they ask them why, they will tell them that because when you are listing taxable income, you did not list my own sort of income there. That's why they put number 4. Any sort of income that they did not mention above, which means that if your own is not above that 1 to 3, it's still part of taxable income. They don't know the name, but it's there. That's what number 4 is for. So now non-taxable income, what are the income that are not taxable? Interest on foreign loan granted on or after. So interest on foreign loan is not taxable. Interest on loan granted by a bank, I think we've talked about this under investment income. Interest on loan granted by a bank after this for the purpose of manufacturing goods for export. No, number 2 is for agricultural company or fabrication of plants, or if you work in a cottage industry. I think if you guys have done cottage industry, I think is it trading clinical and trading block, regional integration and trading block. Was it there? Either
Yes,
there or
yes.
transferring.
Integration and trading blocks, yes.
So what
They
is the
talked
cottage?
about free trade zone and all.
What is the cottage industry?
Yeah, I can't remember.
Yeah, see, I go and tell whether Mr. Razak that you guys do not remember.
Don't tell him more.
It's not your diet according to the information that I got. So you guys should not be tested on the new tax act. But like I said, I always include it in my material. Me, I don't trust ICANN. I don't trust them at all. That's why I always include it that in case you guys should see it. So in case the barry, you guys will not be taking off guard. That's why I'm including it. So, but according to the information that I got, it's not supposed to be from your diet. It's supposed to be 6 months after now. It's not by your diet. It's not yet 6 months. At least those 2 ones that were from January 1st. It's not yet 6 months by your diet. Do you get? So cottage
Sorry,
industry.
excuse me. Sorry
Yeah?
to cut you. But I thought the new tax law, it was brought out last year. Last May, before May.
Implementation for NTA and NTAA is January 1st, and I think the pact says 6 months from implementation date. I guess this is where we say goodbye, you guys. My battery is finally
Please, I
down.
want to ask a question before you go.
There's nothing I can do to you. You have to ask your question either on the WhatsApp group. I cannot even be online currently because the moment I close this laptop, my phone will go along too.
Okay.
I have to
We
go off.
I'll act on WhatsApp, maybe when you charge.
All right, no problem. Guys, I'm really sorry to cut our lecture short. So I'll see you next Sunday. Please read your material and you come with any question. Let me try to see if I can upload CIT2 before I go offline.
Ma, please upload the materials too. Thank you, ma.
Let me stop the recording. If I'm able to do it before.
Hello.